By now, I imagine that you are all hearing about all of the economic and financial phrases of these days, such as deteriorating macroeconomic conditions, the whipping boy of choice for public company CEOs, and that inflation is raging all across the globe. Consumer discretionary spending is weakening. House prices are falling all across the United States, especially in pandemic-era boomtowns in the Mountain West. And, of course, homebuilder sentiment is weakening. And that the National Association of Realtors is crying in their beer because home sales are declining. Well, all of those things are true. And that Q3 earnings in the retail segment are disappointing, especially for Target, Kohl's, Bed Bath & Beyond, and to a lesser extent, Walmart. That this past week, Home Depot and Lowe's stunned Wall Street analysts with strong Q3 earnings reports. So, what's up with that? What does it mean for retail? What does it mean for real estate? What does it mean for the economy? And, what does this mean for the future of the United States? But, before we get into all of that, please press the like button and leave a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos. By now, we all know that the U.S. housing market is falling hard from its pandemic-driven highs. But home improvement retailers like Home Depot and Lowe's seem immune to the same pain. As a matter of fact, they are something of a bright spot in an otherwise weak economy. Normally, home building and home remodeling are integrally connected. But, at a more nuanced level, the market forces behind them are actually different. And those differences are what the real estate industry is experiencing now. Home Depot and Lowe's both reported strong Q3 earnings this week. Shares in Lowe's climbed 3% following the better-than-expected earnings call. Management teams at both retailers were bullishly regarding the prospects for their business in 2023. And all of this comes amid a pronounced slump in housing prices. Home construction is also weakening significantly due to a massive jump in mortgage rates. There is an improve-in-place mentality among current homeowners right now, said Home Depot CFO Richard McPhail. Homeowners who might have wanted to sell but changed their minds because they could no longer command top dollar, McPhail continued. All we can do at this point is repeat what our customers are telling us, McPhail said. There is a dynamic we don't see much in the market. With rising mortgage rates, homeowners are staying in place, McPhail added. Keep in mind that this is still not a dumpster fire with regard to house prices. Home prices are still 11.4% higher in October than they were in October 2021, according to a report by CoreLogic. But that annual comparison has been shrinking for several months, the report continued. Prices are falling month to month at a far faster pace than normal seasonal trends, the report added. If you recall, there was a phenomenal run-up in home prices during the pandemic. This stunning price increase was fueled by record low mortgage rates. Americans also wanted to move to larger homes in suburban areas, especially if they could work from home. The huge price jump gave homeowners huge amounts of equity. In fact, house prices rose by more than 40% in just 2 years. But things changed at the end of the first quarter of this year. The steep and aggressive rise in mortgage rates caused the housing market to falter. Homeowners had a collective $11 trillion in so-called tappable equity, according to Black Knight. Tappable equity is the amount that a borrower can take out of their home while still leaving 20% equity in it. Tappable equity grew by an astounding $1.2 trillion in the first quarter of this year alone. If you divide that by the total number of homeowners, it amounts to $207,000 in tappable equity per homeowner. That equity is part of a three-pronged driver of home improvement, said CEO of Lowe's, Marvin Ellison. Ellison cited 3 drivers. Home price appreciation. The age of the U.S. housing stock, which is roughly 40 years old and that is the oldest since World War II. And high levels of personal discretionary income. So when you look at all those factors, those things bode well for home improvement, and we feel really good about our current trends, said Ellison. Home builders, many of whom work in both home construction and in home renovation, don't feel quite so bullish on their market. As you have probably heard if you follow this channel, home builder sentiment fell in November for the 11th month in a row. It hit the lowest level in a decade, according to a report by the National Association of Home Builders, NAHB. The remodeling sector will fare the best among the residential construction submarkets during this current housing contraction, said the NAHB. The growth rate for improvement spending will slow due to declines for existing home sales, said NAHB chief economist Robert Dietz. However, an aging housing stock, work-from-home trends and a decline for household mobility all favor remodeling spending, said Dietz. Dietz also cites what are called interest rate lock-in effects. Homeowners who locked in a low interest rate don't want to sell a home with a 2.75% mortgage interest rate. If they were to trade up to another home, the rate would likely be around 7% today. The annual gains in home improvement and maintenance spending will decline sharply by the middle of next year, said Harvard's Joint Center for Housing. We expect it to decline to a 6.5% growth rate from an unusually high 16% rate, said the center. Housing and remodeling markets are undoubtedly slowing from the exceptionally high and unsustainable growth rates that followed in the wake of the pandemic-induced recession, says Carlos Martin, project director of the Remodeling Futures program at the center. Spending for home improvements will continue to face headwinds from declining home sales, rising interest rates and the increasing costs of contractor labor and building materials, Martin continued. We all know that inflation is raging in basically all sectors of the economy. But consumers seem to want to spend more on their homes. Interestingly, both Lowe's and Home Depot earnings reports showed a drop in the number of sales transactions. That the dollar amount per sale increased. So that netted out to an increase in revenue overall. There is inflation in the market and elasticity, but not to the degree that we anticipated, and the customer shows us they are resilient, said Home Depot's McPhail. House, a home improvement and design website, recently conducted a survey of nearly 4,000 homeowners. Only 1% of homeowners reported having canceled a home improvement project in 2022, said Maureen Sarkisyan, House staff economist. Meanwhile, 37% completed a project in 2022 and nearly one quarter said they were planning to start a home improvement project in the next 12 months, Sarkisyan continued. Additionally, more than half of the homeowners we surveyed have no intention of selling or moving out of their current residences in the next 20 years or ever, Sarkisyan added. If you follow this channel, you already know that home builder sentiment is in the tank. Home builder sentiment for the U.S. single-family home market has now fallen to half what it was only 6 months ago. The National Association of Home Builders, NAHB, Wells Fargo Housing Market Index, HMI, is designed to gauge market conditions. This index fell 8 points to 38 in October from a level of 46 in September. The index now stands at its lowest level since 2012. The index is considered to be negative whenever it is below 50. Homer builders continue to blame aggressively rising interest rates for the decrease in confidence. The index has 3 components. The current sales conditions component declined 9 points to 45. The sales expectations in the next 6 months component fell 11 points to 35. The buyer traffic component fell 6 points to 25. And buyer traffic is a big indicator because it means that buyers are just not showing up. But, what do you think? Please press the like button and leave a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.